Welcome to Investor Copilot. I am Viraj, and today we will discuss a very important topic, that is basics of margin trades. So let's get started. Now, what is margin trading all about? So in principle, let's say that I am a buyer on the stock market and I need to purchase a security, which could be a stock or a ETF or anything else from a seller. I'm required to pay the full amount of that security to the seller so that I can have that security in my holdings. It doesn't matter if I pay with cash or with borrowed funds, but I need to make the full payment. This is the basic premise. With that, let's look at margin requirement. So a margin requirement, or MR, is a percentage of the traded value of a security that is required in cash to buy it. MR can change at any time based on the stock value fluctuations and ranges between 0% to 100%, 30% being most common. Now, simply put, let's say that the market value of a security is at $100 and I'm trying to purchase it as a buyer. If the MR is set at 30%, then I need to pay $30 in cash for this security, and the remaining $70 I can borrow from my brokerage or anywhere else. This is the basic definition of what is being said here. The MR obviously is not 30% for every stock or every ETF or every asset. It ranges between 0 to 100, so it varies a lot in the market, but 30% being most common in North American markets. Now, an obvious advantage of using margin is that usage of margin over and above the cash available to you increases your trading gains without employing your capital. And this is very obvious. You can trade and purchase assets with money that you don't have, and you can take a position, you can take some risk as well to maximize your gains. But obviously, there's a flip side and there is a risk associated here. So, on the flip side, using margin incurs interest and can result in losses as well, should your investments decline in value or move against you. So this is the obvious downside, but this is what we're trying to counter through this channel. We're trying to educate you so that you make profitable trades as much as possible. Now, we spoke about MR, so there are two types of margin requirements. There is short MR and long MR. Now, what we were discussing just now is long MR, and it is used by bull traders who invest by going long on a stock. Going long means betting on the value of the stock, the market value going up, rising. That is what it means. Short MR, on the flip side, is for bear traders who invest by shorting a stock, which means that they bet or bank on the value of the stock going down or declining. We will discuss shorting concepts later on in this video series. Now let's look at rules of margin trading. So let's start with the vanilla clean scenario. Now, assuming that you have $10,000 of cash in your trading account and you have no securities in your holdings as of now, which means you have not placed any orders, you have not made any purchases. In this scenario, your buying power on your trading account will show $10,000. However, there is a concept of max buying power, and this is always 3.33 times the buying power. So your max buying power will show $33,300. Now, your brokerage always assumes 30% as your default MR, since it is the most common percentage on the market. So going forward, we have to remember these three key formulas regarding your trading account, and these three formulae will tell you everything basically that you need to know about margin and about your standing in the market and your monetary position in your trading account. So you will see all of these terminologies. First is total equity. Total equity is equal to cash plus market value of the stocks or all the assets, all the holdings that you have. This is total equity. Your buying power, as we looked at, is equal to your total equity minus your margin requirement. Your margin requirement is known to the brokerage. It will be dynamically calculated, and your buying power will be adjusted as you trade, because your MR will be subtracted from your total equity all the time. So this is a dynamic process. Max buying power, as we discussed, is equal to buying power multiplied by 3.33. So these are important formulae. Please remember these. Now let's look at another trading scenario here. So let's say that a trader is there on the market. They've not made any trades. They have a total equity and cash of $5,000, which is the same thing right now. Buying power is also $5,000, and max buying power sits at 16,650, right? So this is the starting out scenario. Let's say they make a trade. They purchase securities worth $10,000, and the margin requirement, or MR, is set at 30% for this security. That will result in the margin required on your position being $3,000 and the buying power reducing to $2,000 from 5,000, right? So margin is deducted from their buying power. Cash is negative, obviously. So as you can see, all the calculations, max buying power turns out to be 6,660 for this example. So this is a very basic, simple scenario that you can look at. Yeah. Now, let's look at some of the important features of margin accounts as well. Short selling or bear trading, first of all, is a feature that is only available for non-registered margin accounts. Short selling is something we will look at later on, but this is available for only non-registered Canadian margin accounts. Only non-registered trading accounts are allowed to use margin in the first place and have no monetary limits associated with them. What this means is that, let's say you have a TFSA account or a RRSP account, which are registered accounts, you won't be able to conduct margin trading in your registered accounts in all of these. However, there is something called associating your registered accounts with your margin account. So you can leverage the assets in your registered account towards your margin trades, but you cannot directly use margin trading within your registered accounts. We will look at this concept further, and how to maximize or utilize your funds in registered accounts towards your margin trading later on. Yeah. Another thing to remember is that margin accounts can have more than one joint holders and operators, and this is highly encouraged because margin accounts cannot have a nominee. They cannot have a beneficiary, so they should have joint holdings so that your funds are secure, and right, passing on or inheritance of your funds and your accounts is also secure. So it's highly encouraged that joint holding uh, and joint operation of a margin account is uh, facilitated and being used by you. Now, the lastly, capital gains on your margin accounts are taxed at 50% in Canada. So half of all you make as profits is tax free. So this is a great upside. The government is making you uh, enjoy half of your gains on your margin trading accounts, and you only pay taxes on 50% of your gains in the margin account. That means 50% of your gains are treated as your income. Now, lastly, let's discuss margin calls. So margin implies borrowing of money, so naturally it needs to be paid back and also incurs interest charges. We discussed this before, that it is borrowed funds, so it will have an interest. Right now, for Questrade, case in point, interest is 7.2 prime plus 4.25 variable per annum, which stands at roughly 11.5% as of today of recording this video. But interest can vary, but it's plus 1% generally. So it is at the 12-ish% mark for all the trading accounts that I know of. So in effect, you pay around 0.9 to 1% per month on your entire borrowed funds. That is your entire margin. That is the rule of thumb here. Now, a margin call is triggered when the combined value of cash and or securities used as collateral on your loan drop below the minimum amount you require to maintain your account when borrowing funds. Margin calls can occur if your securities that you hold a decline in value. If you trade in US dollars, you're buying US securities, US assets, and fluctuations in the CAD USD exchange rate occur to a high degree. Or if your MR change on your holdings, that can also happen, and administrative charges are debited, and if you don't have enough cash to cover that. So these are the some of the scenarios where you can be short of funds and you get a margin call. Margin calls can be covered in many ways, by depositing cash instantly, by selling your positions, by notifying your brokerage to provide time, or by borrowing from registered accounts. So that is a great advantage of registered accounts being associated with non-registered margin trading accounts. Brokerages notify traders regarding margin calls on email or phone or your preferred method of communication and expect prompt responses. Brokerages are authorized to sell your holdings to cover the margin gap. And lastly, ignoring margin calls adversely impacts your credit score, borrowing capability, and in rare instances can result in legal action. So, just a word of caution here. Uh, uh, Almost this is a scenario which we never want to see and want to prevent. So, educating yourself as a personal investor is important to avoid these scenarios. So stay tuned on this channel and in this video series, and we will take a deep dive into margin trading, and we will discuss more concepts in detail later on. Thank you very much.